in studio to talk about the situation. One of my local favorites, Mr. Zed Francis, CIO at Convexitas. Zed, what a session. Things are getting wild.
Well, welcome to the great reflation, but correlation is still zero, right?
So we'd be like flipped, right? So it's like the whole market was skewed one way and correlations were very low, dispersion was very high, and now we just kind of inverted that.
Yeah, we're remaining incredibly high dispersion, incredibly low correlation, just a different basket of winners this time around.
Literally the opposite.
Yeah, I mean, like, I think some of it too is, again, like I somewhat tongue-in-cheek say the great reflation, but we kind of had a last 6-7 months where there was 7 names with growth, and then there was 5 names with growth, and there's 2 names with growth. Well, if we're going to have like a reflationary period, that means everything is going to grow relative than what it was. So maybe there's 2,000 names that can now grow. So if you're hunting for that growth in your portfolio, and you kept getting funneled into fewer and fewer names, now you kind of look at the potential opportunity of maybe we just have a nice growth spurt, even if it brings a little inflation along with it, and opens up the toolkit in terms of all the names you potentially are interested in.
Right. Well, the low quality, the higher risk, the junk rated stuff that's really moving here. People kind of digging through to be nice, call it the bargain bin. Maybe it's more like a dumpster, some of these things.
Yeah, I mean, last week, profitless tech outperformed profitable tech by, I think it was like 6.5%. And it's only continued this week. And the most shorted index, everybody has like a different one, but that was up, I think, approximately 9% last week. And again, has continued this week. So along what you're saying is, okay, like we're going for the quote unquote bargain bin, or like the least loved names out there. But I think part of that action too is, if you look at any sort of survey data, most people are pretty darn topped up on equity risk by any sort of historical standards. And if you just became more bullish, you're already very heavily allocated to equities, and you just became more bullish, how do you express that? There's not a lot of easy money to grab to put to work. So you got to like rotate up the beta of your portfolio.
Okay, this is an important one firstly, because this is where I still have had some doubts about the sustainability of this for the index. Well, more so than just the math favors tech momentum more than it does rotation momentum because of the market cap. There's also kind of this question, if more money can come from the outside, though, then everybody can live happily ever after. Is there that much money on the sidelines, or is that sideline cash still getting 4.5%? People don't want to mess with that.
I think generically we're probably close to fully invested by any sort of historical standards. And that's just what percent of folks' net worth are actually already in equities are pretty darn at extremes, right? Yeah. And so if you're going to maintain the same amount of dollars of equity exposure, but you actually want more risk, your choices are somewhat limited. It's beta up the portfolio, sell something with a beta spot 8 to buy something with a beta of 1.5. It's the same amount of equity dollars allocation, but there's more risk in that portfolio. The other thing we kind of saw, which is potentially short-lived, but we saw a lot of call buying in index levels. So that's another way of like $1 of equity-like allocation having more risk affiliated with it. On Thursday, I think it was the highest amount of IWM call volume ever. And so I think you have a blend of both of that, is that people are already pretty long, they're bullish, and they just became additionally bullish, and they're scrounging for ways to increase the allocation with the limited dollars that they already have.
Okay. I'm getting texts from people, all over, and it's a difficult question to answer because they want to now go, all right, well, I want to take all the stuff that I had in the broad market, and now I want to put it in equal weight. I want to put it in Russell, which brings me back to your description about it as reflation. Because if this is and it seems like this is what the market's telling us, the stock market in particular telling us, that not only are we going to get cuts, but we're not going to have a hard landing, that we're going to get cuts for the right reason. The catch I still have, and maybe people are going to get tired of me talking about this, but when you look at the curve, it looks like a lot more what just almost always happens at the end of a cycle. We've gotten bull steepening. If I were thinking reflation, there's a Trump trade, there's fiscal, there's warm up in the economy. Wouldn't that be bear steepening? Is the bond market here not telling us look, this is just pretty routine end of cycle stuff?
Well, you've gotten the steepening, right? Like it's not overly dramatic, but it's pretty decent.
A bull steepening.
2 weeks. But a little bit of a bull.
1 day of bear steepening. Actually, it's flattening today.
Yeah, today is different than the last 10 trading days, for sure. But a little bit of it is what's the first move? The first move is pulling forward the expectation of rate cuts, obviously pulling the front end of the curve forward. Now, Eventually, do I think the long end starts saying like, okay, yes, rates are going to get cut. That makes it potentially first move attractive to own a little bit more duration. Maybe that's not where we sit for more than a couple of weeks. I think that's going to be the telling story. But the gut shot reaction is cutting rates, buy duration is kind of the instantaneous reaction by most folks. But even with that, as you say, like, 10s and even 30s are basically unch over the last 2 weeks, 10s approximately. So this has all been on the front end of the curve so far, as you say, like a total bull steepener. But I think it's gut shot reaction versus follow through, and the follow through is what's going to be interesting because yes, if all of a sudden the long end starts creeping higher, the real growth and potential future inflation expectations start pushing the long end higher, then we might have some difficulty for risk assets as that becomes competitive to risk assets. But for right now, when we're kind of staying locked in the low to mid fours, it's kind of an all clear for the moment.
It just seems like this type of rotation and Russell ramp is what was supposed to happen like third quarter, second quarter last year when we were bear steepening, when we were pricing in higher growth, when the GDP expectations were going higher. In the last week, we did get a little, because the retail sales too definitely helped our GDP estimates. But I mean, net on the year, obviously GDP estimates have come down. These things seem like they're a little bit at conflict with this massive optimism that we're seeing in the cyclical stocks.
Yes, I think that's the shift, is we have a little bit of a change in expectations for future policy as well, right? So obviously we have, Fed cuts being increasingly priced in due to slowing headline inflation data, but I think we also have policy changes being priced in, and things like deregulation are definitely going to be much better for the smaller caps than the larger caps.
And you're talking Trump trade, basically.
Yeah, and my simple argument for that is most of the mega caps, if you will, yes, we focus on them being regulated entities, they get all the headlines, but the amount of regulatory pressure that's in the system kind of creates a little bit of a barrier that allows them to maintain their outperformance from everybody else, where true deregulation probably just allows other folks to participate rather than necessarily a big shift at the top.
I love your macro discussion. What you do at the end of the day, though, with client money and portfolios is wrap options, wrap volatility ideas around it, and VIX up, stocks up. I know you're not a big VIX fan, but that does kind of point towards like this kind of speculative call skew, does it not? Or kind of give me the 60-second rundown of what we do with this volatility here.
Yeah, so on the skew side, IWM very specific. Lots of call buying. We actually have inverted skew in IWM. So again, like calls more expensive than puts from implied volatility standpoint. What ultimately I still think is the most interesting thing is realized correlation is incredibly low, basement low. I mean, we had 1 month realized correlation as like a 3. So nothing in the S&P 500 is correlated. Yes, that it's filtering into implied correlation, meaning folks are expecting that low correlation to continue to go forward. And ultimately that means that there's a potential correlation kicker or pop in S&P 500 options, meaning if correlation just normalizes, that's going to push vol significantly higher, even if everything underneath the surface is moving exactly as it currently is. So you have a kind of additional variable, if you will, that makes the potential of being long options and index more interesting here than potentially other periods of time.
Interesting. Okay, so and we could get correlation to come together. Does it work for the upside and downside?
Yeah, it works upside and downside, right? I think most folks, again, because as you say, holdings have become pretty concentrated, so it felt like good correlation over the last 6 months where S&P kept going up and everything underneath the surface was going in different directions. 90% of stocks probably weren't doing all that great. Now it's the opposite right now.
It's the opposite.
Folks are like, I don't know if my portfolio is doing that great, even though 90% of the stocks are up. So it's what you hold ultimately at the end of the day. But yes, could be both ways, right? If all of a sudden the opposite, okay, everything's great, tech joins the small cap rally, we can get some real movement.
Oh, yeah. That's what they're trying to do today, but basically it's only Tesla. It's up. Well, Apple flipped positive, too. Great stuff, Zed Francis. Thanks for the analysis.
Thanks for having me, Oliver.
Always good conversations. Zed Francis, CIO at Convexitas. We're going to talk some tech when we